Investments Mark V commentary for Monday, the 30th of March. If you'd like to type a question or talk, please go to the I think it's the question section or the chat section. Either one, I'll do the best I can to see them and get your questions answered. But we're probably going to spend about 40 minutes today on the teaching side of this. Okay, someone asked me earlier today, first of all, first day of the possibility of and I have no idea how to say that, the island, or over 60% of Iran's oil wells, which apparently are part of what they call this island, will be destroyed if the U.S. bombs it. Kevin, why would they do that? Well, we sent over a 15-point resolution, and they sent back a 5-point resolution, but there were some pretty clear disregard to international waters. Hey, we control the strait. Hey, we do this. So needless to say, my biggest concern is, yes, we probably are going to see of that 20% oil that comes through the strait, over 6% of it comes from Iran, and we are probably going to see oil prices continue higher, especially if the U.S. decides to bomb their island, which will decimate something like 60% of Iran's oil capabilities, which is 6% of the oil, over 6% of the oil that comes through the strait. Someone else asked me, and I found it very interesting. Kevin, what do you think about Trump making the stock market down? And this isn't about politics, guys. It comes down to the simple idea. I would rather have the stock market down for a while than have the possibility of 11 or even one nuclear missile fired from the Middle East. It's that simple. If a nuclear missile was to go off anywhere in the world, I believe with jet stream patterns, it could affect countries across the globe. Some of you asked last week about barrels of oil. I've got a couple different pictures here, and they're kind of interesting. I almost feel like the picture on the left is more of Europe. The picture in the middle is more of, I almost want to say Middle East, and the picture on the right is more of the U.S. But roughly 43% of a barrel of oil is gasoline. Somewhere between 23 to 27.4% is diesel. And then there's this extras, lubricant and waxes, other, so to speak. I'm not sure exactly where we would use those, but next comes jet fuel, petroleum coke, heavy marine fuel, 2% asphalt, 2% petrochemicals. So that's the breakdown of oil. And again, it seems like on the left is Europe, in the middle is Middle Easterner, and on the right is more of the U.S. So you'll be able to, as I post this, you'll be able to open those up, stretch them out, see a little bit more. Kevin, are you saying the U.S. uses more diesel or creates more diesel? Yes, I've got a link underneath the pictures, the difference between crude and heavy crude. As I said before, and I found it somewhat interesting, yes, the U.S. has a lot of heavy crude. We do import light crude from Canada. Most of my stuff came back to 2022, but here's the short answer. We do a lot of light crude because 60% of U.S. refineries are set up for heavy crude. Light crude is easier to what's the word I'm looking for? Easier to refine. But a lot of what we get into is heavy crude. So it's nice to have a domestic partner to import our crude from. Understand this is 1924 was the last time we had the U.S. Energy Information Administration put it together. The fact that we are now tariffing imports from Canada does not help our oil industry. And so we will be in a bit of a problem or a tight squeeze in regards that, dang it, if we're going to tariff our neighbors, yet we want that light crude, the process of refining means that it's a little more difficult for us. And when you process heavy crude, there's more time, labor, and expenses, which makes your barrel of oil more expensive. Well, Kevin, West Texas is cheaper. Yes. And I don't have an answer for that for people that have talked to me, but I'm just sharing information from previous questions that were asked, and I'm trying to make sure I get all of those filled out for you. I found it interesting. A lot of people are saying, what is going on with the sold off chips? And I found this in just briefly as I was looking through why chips are selling off. Investors sold off chip stocks amid concerns that prolonged conflict could disrupt global supply chains and push inflation even higher across the semiconductor industry. That goes 100% against what Jerome Powell said today. But I found it shocking that Jerome Powell, although he doesn't use the word transitory, made the comment that, hey, he doesn't see inflation staying around. It is transitory due to the fact that we attacked Iran and the United States has slowed down the global supply of oil. But the moment he said, I do not see a rate hike in the future, our markets went down. It's unbelievable when you're dealing in a sentiment driven market. And I mean, it's just, let me put it this way. When you are in a sentiment driven market, facts and figures, comments from leaders, and reality all gets distorted. Hurley Investments just made well, let's put it this way. We made the decision, hey, we're protecting everything. We're protecting everything 100%. And I think someone asked me a question. I'm going to move it up here because I think it was important. Well, I'm going to move down to it. Someone asked, Kevin, is every account really important to you? And if it is, why? And it really comes down to this. And I hope I can put it into perspective. I'm going to say our accounts because Key, myself, Brian, Spencer, we're all investing in the same thing. We're all investing in the same way. So our accounts get hit the same amount as yours. The other side of things, if we lose 10% in an account, percent I should put it this way, an account that we are charging. That usually means we're losing 10% roughly. In all accounts, which means we get paid 10% less for that month. So imagine if you had a moving or a variable income coming in that changes month to month. It's very important for us to make sure that we're smoothing out the bumps in the road. Not so much that we're going to just throw you into the index and say good luck, but it's very important. Every single account, because we manage them the same way. Why? It directly affects our accounts and our invested money. It directly affects our income. It's really hard to live off of an income that can fluctuate 10, 15, 20% over a quarter. Imagine if you're trying to live off of an income that could fluctuate, again, 10, 20%, being down 38% in a year. Could you imagine being in an income that you lose 38% of your income in a year? Because that's what the market gives you. So yes, every single account is extremely important to us. Someone made the comment last week, not all AI can be profitable. I might shoot back with why, because all auto industry participants all online movie participants, all stores, gas stations, refiners. I can come up with a lot of different industries where all participants can be successful. Now, I mean, I could do computer makers, I could do phones. I used to think that not all participants can be profitable or make it. Thanks, Bill. But I'll be honest with you. I'm the guy that has like 19 different online subscriptions to entertainment. And I think I've gone through this with you before. History Channel, Apple TV, Netflix, Paramount, Discovery Go, Prime Video, Disney, Xfinity Stream, Living Scriptures, Peacock, Hulu, Angel, Pureflix, Tubi, Vet TV, HBO Max, The Chosen. I've got Angel TV. I already said that one. Sorry. I've got quite a few. And I think we sometimes put AI in a box. Not all can be profitable. Well, I can come up with dozens of industries that people thought they couldn't all be profitable, and they're significantly different significantly different companies that all participate in the same arena, and they're all profitable. So I think this thought process of not all AI can be profitable, I'm going to politely disagree, because I think they're each going to find their niches, and they're each are going to be in different areas where they can be profitable in. It'll depend if they get there. I sent an email over the weekend. Some of my new guys, hopefully Brian and Keeve, are also forwarding these emails to you, or they're going to make them better. But we had some issues with Money Block. And the simple answer for it is, this is the blue money block. This is the orange money block. Legacy is the orange. The blue one is what they call their app. This is their app money block platform for you. Houston, we have a problem. The blue money block was not calculating the correct totals at the end of the day. 7 of you had called us and said, why am I not hearing from you? Oh my gosh, how much have you lost? Holy Toledo, Kevin. You're freaking me out. And we're like, wait a second. Those numbers don't add up. So we threw a whole bunch of screenshots into Money Block, got right up in the face of our vice president. And to his credit, he's like, you know what, Kevin? We don't want to lose you or anyone. Let us look into it. And the response back to me was, it has to do with the same issue identified earlier with not all option values getting picked up in the after hours market pricing feed. So what was happening is they weren't valuing options correctly. They were coming across, and for some reason, in a lower case from the market feeds that they were getting, which means it had a zero value. It also seems like mathematically, the cash wasn't being added back into the account. So the tech folks have been troubleshooting, which they did all weekend long. It sounds like all hands on deck from about Friday evening till this morning. The tech folks have been troubleshooting the issue and are working on a solution. I know you don't like to get these calls or messages from clients anymore than I like getting them from you. Gary Martino, what a stud you are. I've emphasized the urgency to get this fixed as quickly as possible, and again, apologize for putting you guys in a situation to start with. We are not the biggest guy in Money Block. We do fit in that top 10, I'm pretty sure. But what we are is we're the brokerage house that grows more year over year over year, while the majority of these guys seem to be shrinking. So I found it interesting that, again, they had all hands on deck working all through hours of the night, Saturday, Sunday until Monday morning. And we will probably see an update come out tomorrow or Wednesday, which means you will not be on your brokerage house for about 3 to 4 hours as they put their patch or their fix in. Okay, 2 things in regards to trading about what we do. And I want to hear, some of you are new that are here. I definitely want to hear from you guys. I saw Tanya came in today. Tanya, if you can answer some of these, I want to hear from you. I want to go through the caller trade. I want to go through our stock replacement strategy one more time with you. And we made some adjustments today that I want to make everyone aware about. Let's work through the caller trade. We talk about our caller trade, and we like to protect stock ownership. If you buy a share of stock that's worth, let's say, $100, how much is the risk in purchasing a $100 share of stock? How much risk is in purchasing that $100 share of stock? Bingo. I got answers coming in. Thank you, James. You're the first. Every freaking penny. Or a penny. I'm not sure what a penny is, but we'll call it a penny. So, if, because we like to be in, for the most part, 1,000 shares, in real life, you have $100,000 of stock risk. This works for, and it's the same stock risk for a mutual fund. You can diversify your butt off, but the risk is still there that the U.S. market gets shut down. Trump could do something stupid and they piss off the wrong hacker that shuts everything down. I don't know. Every penny you put in the stock market is at risk, which is why they tell you don't trade with money you can't afford to lose. A good stockbroker will do 3 things. He'll spend time understanding your situation that you're in life. Number two, he will try to get your house paid off as quickly as possible. Number three, he will create a way that not every freaking penny is at risk. Don't get me started on 60-40 portfolios. I went through that last week and a couple weeks before. They're even worse. And if we learned anything in 2009 and 2008, 2020, that 40% that's supposed to be fixed income is just as much at risk as anything else you put your money into. Bonds, corporate bonds, muni bonds, high risk bonds, junk bonds, they're all have the opportunity to go out of business. So $100,000 at risk. I'm going to go back to a per share account because it's easier. What we like to do is buy a protective put at the money, which would be about $100. We usually want to bring it out in time 2 to 3 months, because that last 30 days, you go through significant time decay or time crush, kind of like volatility crush, but your beta kicks up and it shrinks down your gamma goes up and it shrinks down. Brian, correct me if I'm wrong. Brian is our volatility expert. And the thought process is it should cost no more than 4.1%. Which means on a $100 stock and you buy a $4 protective put, your new cost base is $104. What is a protective put? It is nothing more than a long put, which gives you the right to sell your stock at a certain price for a certain period of time. So if you spend $104, or as I like to call it, your new cost basis, what is the risk of your new cost basis? And we're doing this on a per share value. You buy your stock for $100, you spend an extra $4 on the cost of protection, buying the right to sell your stock at a certain price for a certain period of time, buying the right to sell your stock at the money, which would be at the $100 strike price. What is the new risk in your trade per share? I'm not going on until someone answers it. And that's probably Tanya that's trying to raise your hand again. Tanya, if you're on the web, down below there's a questions section or a chat section. I really can't unmute you. I've kind of muted everyone up. So maybe just think in your head, write it down, send me an email. But what is the risk if you have the right, if you buy a protective put at $100? There we go. I see a bunch of answers coming in. Your new cost basis per share, or risk in your new cost basis per share, is $4. For that 2 to 3 month period of time, you have the right to sell your stock at any time you want to for $100. So Your new risk in your trade is $4, or roughly 3.9% of your total invested capital. And I just call that your tick. There are times we like to lower the risk even more by selling a covered call. Covered call is an obligation to sell your stock at a certain price for a certain period of time. In this case, if we were doing it straight out of the gates, it'd probably be at $110, 10%. We would receive somewhere in that $2 to $2.50, really what we're looking for, credit to be obligated to sell stock at a higher price than our cost basis. Overall risk per share, per hair. Man, if I could only type better, you guys wouldn't have to see all this. Cost of our stock plus the $4 cost of protection minus and we usually try to get it at that $2.50 covered call credit equals a total cost basis of $101.50. Overall risk per share, as long as we keep the protective put in place, is only $1.50, or 1.4% of your total invested capital, or on 1,000 shares that we spend $100,000 on, is $1,400 of overall risk on $100,000 of your investment. Someone just asked, typical period of time. Tanya can type in, yes. We usually want to go 2 to 3 months out in time. Our key is to get through an earnings event, which is our trigger. The primary trigger is an earnings event where we want it on a couple weeks before and 6 to 8 weeks after that so we can follow the trend. So I have that in there in our notes. Now, there's a reason we do this. Because what does Hurley Investments do if the stock loses 50% of its value? Well, the neat thing is, if a $100 stock goes to $50 and we can still sell at $100, short answer is we are dollar cost averaging for you and picking up twice as many shares of stock. How are we doing that? We can exercise the put, sell at 100, buy back in at 50. We can just take the profits from the put, buy back into more shares of stock. Either way, we lose the $4 for protection. But we now gain twice as many shares of stock. New cost basis. After we dollar cost average, new cost basis. Well, we have that $4. Divide that by 2 shares of stock now equals $2. Each share of stock has a value of $50. So our new cost basis is roughly $50, $52. Sorry. It's even less if we sell that short call, that covered call. But I'm trying to give you the worst case scenario. When everyone else stays in a stock position that loses 50% of its value, or 60-40 portfolios that lose 50% of their value, like 2008 and 2020, if it goes down to $50 per share of whatever you're invested in, you now need 100% return on that $50 per share to get back to break even. A 100% return is needed to get back to break even. For us, at $52, it's a 2.5% return. Let me work the numbers. 2,000 shares that in 2 years or 3 years or 4-year period of time gets back up to $100 per share. For you, that's going to equal $200,000. While everyone else waited to get money back from 2020 and 2008, this is what we were doing. The reason why we looked so good last year, we looked so good 2021, we did this. Things came back. Everyone else got to break even. They're like, I'm selling this crap at a break even. After it took from 2009, 6.5, 7 years. For us, are we truly $200,000 profitable? Well, no, we probably spent $10,000 to $12,000 to get there. We'll even call it 20. But this is how you get an 80% return in a single year when things finally move. This is what we're doing. We got out of Micron at like a 450% return, getting in the stock between $72 and $85. This is how we did. We had lost half its value, we added more shares. Lost 35% of its value, added 30% more shares. Lost 25% of its value, added 20% more shares. And we got out of Micron at $2.50. At that point, we went to a stock replacement strategy. Micron. Let's see here. Micron, I'm just going to use a simple intraday. 3 or 4 weeks ago, 2 or 3 weeks ago, it was $470.14. Keep that number in mind because I want to show you something really simple. Micron was $471.14, but today it closed at not a good number, $321.80. It lost $149.34 over the last 2.5, 3 weeks. If we were in our minimum 300 shares, you would have lost roughly $22,500. I'm going to copy this because I like it. $149. I guess I might as well do the numbers. 149.34 times 300 shares. Excuse me. I need to learn how to do math. $42,802. If we change that number to 500 shares that we had some of you in, I already worked this number, we would be taking a $74,600 loss. And if we were more in that $1,000 range or 1,000 shares, you would be taking $149,300 loss in stock ownership. Kevin, you do things different. Yes, we would have protected, but I'm kind of going against the market. Someone asked last week, how are you calculating how well you're doing? Well, to the best of my knowledge, even with our broker not calculating things properly, no one's lost $42,802 in a small account. No one's lost $74,600 if they could have owned 500 shares. On our $1,000 share people, no one lost 150 grand on a single position. Why? We use leap long calls. Right to buy stock, obligated to sell higher. And I took a couple pictures of it right here. Brian, good point. Give me a quick second. And this particular bull call strategy that we're using, we have the right to buy at 220, obligated to sell at 300. We're still profitable, even though we took a bit of a loss today. But we spent $62.75 for the right to buy the stock. We took $37.75 as a credit in that we're obligated to sell the stock. We have $25 of maximum risk in owning or representing 600 shares of Micron. If we own 600 shares, add another another 14,000, we'd be losing like 90 grand. In our stock replacement strategy, we're still profitable. Six contracts that represent 600 shares was more profitable a while ago. I'll own up to that. But please, at no time did we ever promise you, hey, we're catching the tops of tops and the bottoms of bottoms. You won't miss a penny of profit ever because we are that good. No, we've never promised that. We never will promise that. But we took some of your profits, about a third of your profits, and put it into Micron stock replacement strategies. We did it where the most you could risk getting into this, I want to say a year ago, but I'm not sure when this one was, some time ago, 6 months ago, maybe. We took $25 of risk. Well, how much is that if it represents 600 shares? Great question. It's $15,000 of risk. But the point is, we're still profitable, even after a $149 per share drop that if you own the shares could have lost you $88,000, we're still profitable in our Micron bull calls. If Micron breaks 300, we're going to get out of this one as well. You'll notice we took some profits in Micron on your stock replacement strategies today. It broke some levels that it should not have broken. We're taking profits. If it reverses, we'll put these stock replacement strategies back in at higher strike prices for longer periods of time so we can make our money back. But we're not taking positions off for huge losses. We're taking them on for a profit. I love showing the meta ones. Kevin, why have you not taken meta positions off? Well, part of it is we made money so on these, what I'm looking for, here we go. On these ones, excuse me. On the Meta 750, 850 bull calls expire in December. These are risk-free trades. Doesn't mean we want to lose money on them. But we had prior short calls that completely paid for our long calls that we took off. We then added new ones back on when Meta went from like 750 down to 600 or 595, then back up. Then we added new short calls on. Then it fell again, and we decided, you know what? We're going to add some more at the bottom, and we added new short calls. So not only did we already pay off our first ones of 130, but then we added a second set to lower the cost basis to $88.99. And we took more credit in than what we paid for the second set. What we spent $47.25 on, we took a credit against those of $49.85. The worst you could do if Meta goes to zero is make $2.60 per share, times that by 100 for each contract. You are in a 100% risk-free trade on your 750, 850 stock replacement leap bull calls. Kevin, you're not exactly in that same position here. You spent $33.35 on these ones. You are correct. We bought the right to buy the stock at 620. We're obligated to sell it at 700, $80 higher. We took a $65 credit in. We spent $33.35 on a stock replacement strategy when we either got out of Meta for you or for new people who could not afford Meta. Does anyone know how much Meta has lost in the last 7 weeks or so from the start of the Iran war? 743 down to 536. I see over $200 that Meta stock ownership has lost. Maximum risk you can lose is $33.35. A stock that's already lost over $200 has you losing exactly 13. Let me state that one more time. On a stock that has lost over $200, has lost your investment $13 per share, per contract. On this one, there's 400 of them. So let's do the math. $13 times 400. Well, it's right there, $5,100, right? It should be 5,200. For stock ownership, significantly different. 400 times 200. Which would be 80K. We set the trade up for significantly less risk. We primarily do this strategy for small accounts that can't afford blue chip stocks. We do this for small accounts that can't afford mega, 7-Eleven, 1719, whatever you call it as. But we set the trade up to give you significantly less risk than stock ownership. Let me get to that in a quick second, please. This is what we do. We lower the risk in your accounts. Meta's down 35, 40%. Nvidia's down 40%. Palantir's down 50% almost. Micron blowing chunks down 35%. We set up your portfolio to give you the gains you had last year, and we set up your portfolio this year to protect those gains and to protect your money. I'm just going to go through a couple quick things here, and then I'll get questions answered. Market participants are no longer chasing higher, rather they are picking spots to average down an environment where phases like stagflation, recession, rate hikes, and tight inflation conditions are a credible part of the market narrative. It is also featuring talk of private credit concerns and AI disruptions. Is that understanding and when it is no longer in doubt are equally important. The longer the war drags on, the longer the energy price shock and supply chain disruptions will persist and upend global activity in lofty markets. Someone just asked, is now a good time to get into Meta or anything? The answer is no. The answer is we're keeping our protection on until there's a resolution to the war. We're not comfortable taking off Disney puts or Boeing puts today when the stocks were up $2 or $3. It's not worth the risk. I've got some interesting news items in here, but yeah, I just have stuff for you guys to read. Netflix raises prices. Google sells part of stake in Fire business because I'm already owner of a new venture ship. These companies are doing everything right. It really comes down to supply chain disruptions. Netflix raises price across all streaming plans. It should do better and make more money. Jim Cramer, as much as I don't like the guy, he's spot on right now. No such thing as a presidential put. Trump can't talk the markets out of a rut. You better be protecting yourself. And we also have a hedge fund guy that thinks the stock market can come significantly farther lower. Kramer doesn't think Nvidia is a good time to buy last week. And there's one hedge fund investor that says prepare for more downside. The market went too fast, too quickly, and there was only a handful of stocks that were justifying the the S&P 500 growth, those were the Mag 7 stocks. So questions for me today. By the way, market closed on Good Friday. Thank you that we get a 3-day weekend. Tomorrow could be a bad day, last day of the month, but I'm not sure who hasn't sold off. Wednesday, Thursday, we could see a bump up as new money enters into the market. But are there any questions you guys have for me? I know I went through a lot of stuff there. I'm going to work with my son Tad to get this posted tonight so he can see those numbers and review those numbers. And Maud, if not just Maud, but if anyone is thinking of putting a position on, you better plan on it possibly losing half of its value and needing to adjust it or dollar cost average it. So we have a lot of cash in positions. We have not deployed it. A lot of you came on at the beginning of the year. We don't just throw you into position so we can start to charge you. We really pick and choose. We run our portfolios under the budget style of finding undervalued stocks that have the opportunity to double in value throughout the year. Someone made a comment, and I missed it earlier. Kevin, you know put pricing is more expensive than 4% right now. Of course we do. Put pricing at 4% of the cost of the stock is somewhere between the 12 and the 19% VIX. When you add the VIX up at 36%, it's usually a third or more higher. But the VIX below 20, usually between 12 and 19%, as standard pricing for an option is 4%. That's why if we're adding any put options on at this time, something that we haven't done before when the VIX wasn't that high, we're also adding a covered call. You'll see how we did that for Boeing shares. You'll see how we did that for Disney shares. We did that for Micron when we had it on. We did it for Ford. We're going to take advantage of the higher pricing on the puts by counteracting it with higher pricing on the short calls. That's also why we spoke last week. We spoke last week about using short calls for minimal protection on the downside because the VIX was elevated and because the cost of puts was elevated so high. I don't see any questions coming in, so I'm trying to delay here just a little bit. I just used 55 minutes. I shot a lot of information at you. Does anybody have any questions about how or why we do what we do? And I hope some of you are seeing the dollar figures from loss on stock versus what we're doing with the elite bull calls as a stock replacement strategy. Some of you might be at a 10% down, but a 10% down on a 30 to 40 to 50% drop on stock, that's exactly what we're looking for. You guys have seen us already add 10% more shares or another 100 shares to Key Corp. This is what we're looking for. Is it fun? No, a down market that's sentiment driven without fundamentals sucks. It's an awful market. It's definitely not fun. But I'm going to hang my hat on the fact that I still believe our market will be significantly higher at the end of the year, not because of something that Trump does, but fundamentals. Fundamentally, when this is over, gas prices should go back down. Fundamentally, 20% of the world oil goes through the strait, and now that 20%, almost 15% of it goes to China and Russia. Crimea freaking river. Oh my gosh, we have midterms. Republicans are going to lose the House and the Senate. Or you're going to see all representatives or politicians give away the House to make the American public happy. That's what happens during election years. I have a belief system based on past history that tells me, especially during an election year, we should be higher at the end of the year than we are at any time during the middle of the year. If you disagree with me, please, 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 please send me an email or argue with me. Tanya, I post all these at myhurleyinvestment.com. Tanya's one of my new gals, love her to death. But Tanya, the good news is we answer the phone for people. We're going to get this posted tonight. Maybe look it over tomorrow, the next day, and then give me a call. We're available. We don't hide from the phone. We talk to people. So if anyone doesn't understand some of this, a little confused, go call your representative. We all pick up the phone for you so that you understand what's going on. Guys, I appreciate you being here. I've kept you a full hour tonight. Everyone have a wonderful Easter. Enjoy your 3-day weekend. Again, always nice to have people attending this. This is what we do. We don't hide from our phones. We give you guys as much information as possible so you know what's happening to your accounts and why. Please start signing in to Legacy. The blue the blue app and the blue newer version of MoneyBlock is not calculating your stuff properly. Hey, appreciate it, guys. Thank you, Tanya. Thank you, Abraham. Appreciate you guys being here. Have a wonderful Easter, and I look forward to meeting you guys next Monday on our next commentary. Good night, everyone. Bye-bye.